Hello, I'm Kevin French from Core Wealth. We're going to be looking at the month of April 2026 and what happened in financial markets around the world. During April, the figures for the first quarter economic growth around the world came out, and generally it was better than expected. What we've seen in the first quarter is that there's continued spend in the US on artificial intelligence infrastructure. There's also been some continued fiscal spending around the world by governments, and that supported economic growth. And then the turmoil in the Middle East has also shaken things up a bit and caused the oil price to rise quite sharply. If we have a look at countries, the economic growth in the US was fairly strong, up 2.5%. We saw economic growth in China, which is the second biggest economy in the world after the US, up 4.5% for the first quarter of this year. Now, the turmoil in the Middle East has caused oil prices to rise and often over $110 a barrel. We expect that we could see this come down to probably around $80 a barrel. So not quite back to where it was before the turmoil, but around $80 a barrel by the end of this year, if there's a settlement that is reached. In addition to that, the International Monetary Fund is projecting that global economic growth could end the year at around 3.1%. That assumes that the situation between the US and Iran is actually peacefully negotiated. If it drags on longer, we could see that number drop down to 2.5% or even 2% growth for the year. Now, while the turmoil in the Middle East persists and the closure of the Straits of Hormuz has had a particularly negative effect on oil prices, every time there's been some semblance or idea that there could be a peaceful resolution, we've seen that markets move into what we call a risk-on strategy. Investors start seeing, well, actually, we should be investing. And that's had a particularly strong effect at the end of April. In addition to that, we've seen some strong earnings results come out from some of the tech businesses, which again has driven demand for those shares. The other area during April that was quite strong was the emerging markets around the world. And we'll show you those returns in the coming slides. In South Africa, during the month of April, we saw a modest recovery across the board. Equities were up, listed property, bond markets recovered quite nicely. But the big question is, what about inflation? We saw some significant increases in the fuel price, and there's further increases to come. And if that has a negative impact on inflation, it could see particularly bond markets weaken quite a lot. The one area that we've seen is that our Reserve Bank governor has come out quite clearly saying that, yes, they may need to raise rates, and we think that we could actually start seeing a rate increase at the end of May meeting, but that would just be to show the market that they're serious about keeping inflation under control. And if there's a positive outcome in the Middle East, we could see those increase in rates actually start reducing by the end of this year. So let's have a look at how markets have responded. And you can see in this first slide that for the month of April, a lot of green and some really strong moves in developed market equities, up some 9.6% for the month of April. Emerging markets up even stronger than that, 14.7% just in 1 month. This now, if you have a look year to date, just shows that basically all of the returns for so far in 2026 have come through in April itself. The 1-year numbers look particularly strong, but that is really just from a timing point of view. At the end of April last year, the markets were quite low, and we've seen a big turnaround over the last year. But if you have a look at the 3-year column, you can see Japan has been a continued strong recoverer over the last 3 years, 24% per year over the last 3 years. Emerging markets also an area where we've seen significantly strong returns. But developed market equities in general also up almost 20% per year over the last 3 years. So significant improvements in equity markets around the world over the last 3 years. For our South African investors, looking at the same thing, these figures are now in rands. The previous graph was in US dollars. We can see that for the month of April, again, some improvements, particularly the listed property and bond markets up quite strongly. But if we have a look again at the 3-year column, looking back over the last 3 years, listed equity markets up almost 18%, listed property doing very well. And we can see over the last 3 years, the rand has strengthened against all the other major currencies and at 3% per year over the last 3 years. Really strong returns in the longer term, and something that we're seeing coming through in our portfolios for clients, that they've generated significant real returns above inflation. If we have a look at our global models, we can see, particularly over the last year, I'd like to just focus on that. Here we're looking at the US dollar models, and our global growth model is up 25% for the last year, and importantly, almost 5% ahead of the peer group over the last year. And similarly, you can see the more conservative models as well doing exceptionally well against their peers. A lot of that driven by the underlying managers that we use, and then importantly, some of the tilts that we've had towards Japan and emerging markets, as they've done very well. Similarly, if we have a look at the global models that look at the world through a sterling or a British pound lens, we can see similar results, just over 23% for our global growth strategy, and that in itself over 5.5% ahead of the peer group. So some really good returns coming through on the global side in hard currency. The model that we'd like to focus in on this month is one of our sterling models, which is the global balance strategy, but in British pounds. And you can see from this slide here, this just looks at the track record. The model was only launched in October 2021, just before the worst year in a number of years now, which was 2022, when we had the Ukraine invasion, and equity and bond markets both struggled during that year. In fact, both of them were down, and it was a worse year than the COVID year, for example. However, what we can see from this graph is the green line is the peer group, and the purple line is the core wealth strategy, and we can see that that's comfortably ahead of its peer group. It's a 4.5-year track record, and we're looking forward to reaching that 5-year milestone in October of this year. One of the managers that we'd like to highlight within this strategy is the HSBC Global Balance Strategy. It's run by Nicholas McLaughlin from HSBC, and it's a fairly large fund, some £6.6 billion. We've just shown you there just how that has performed versus its peer group, done particularly well, and over the last year done very well because it is a more US bias type strategy, but particularly looking for growth type companies. You can see from the top 3 companies that it's got exposure to: Nvidia, Apple, and Alphabet, all technology related businesses, and those have done particularly well over the last year within that sector. If we have a look at the Sterling Global Balance strategy, we can see from this slide here where it's actually invested. So where have those managers allocated funds? The bulk of the funds are allocated to equities, foreign equity there, 57.5% exposure. If you look on the right of this graph, we've shown the equity versus the peer group, which is the gray bar. And then if we look at growth assets in total, because in the strategy managers are also investing into some commodities, for example, the growth asset exposure is higher than the peer groups, but that is something that we're quite comfortable with, in that most of our clients who are invested in these balance strategies are going in there for long-term returns. And that's the reason why we're happy to have a higher exposure than the peer group, and that results in additional performance. So here's the usual table of our South African models. Again, a very healthy picture and some really good outperformance over the last year. Our retirement growth strategy outperforming its peers by almost 6%, which is an exceptionally good year. But what I'd like to focus on is the 5-year figures. And just to give you some context, an investor who was invested in our retirement growth strategy, that strategy achieved a return of 14.2%, which basically means if whatever they'd had at the beginning of that 5-year period has now doubled in value at a return of 14.2%. So some really strong tailwind returns and some good outperformance of our peer groups has led to investors doing very well over this 5-year term. So we're going to have a look at a few slides as to what the outlook for European markets looks like. And this first slide just shows the energy squeeze that they're experiencing at the moment, and the concern around oil prices at $110 a barrel like they currently are is that that could add about 1% to European inflation, and in addition it could even slow down their GDP growth or economic growth by 0.6%. And this is on the back of what we've seen just recently. The graph on the left hand side just shows you how oil prices have changed, which is the red bar, and they've gone up to $110 a barrel, and then the blue bar is the Dutch TTF gas, and that's gone up to about $45 per megawatt hour. Both of those could be a strain on economic growth and a push to European inflation, which would be a negative. So there is something called stagflation, which means inflation is going up and economic growth is coming down at the same time. Not a place that any economy wants to be. And we've just had a look at that with these graphs that you can see here. On the left-hand side, we're looking at the Purchasing Managers Index, which is an indication of economic activity. The blue line just shows manufacturing, and that has continued to improve in Europe. However, when we look at the composite, which includes manufacturing and non-manufacturing, we can see the composite of those two, which is the green line, is actually below 50. And 50 is kind of the critical level as to whether things are growing or not. And the concern is that we could see inflation heading higher, which is what the graph on the right-hand side is showing. The blue line is energy inflation. And if the red line starts picking up, we could see an inflation situation and economic growth slowing down, which is not where we want to see things in any economy. Germany, which is one of the biggest economies in Europe, is an example of some of the risks that are quite evident for the whole region. On the left-hand side, we're showing the Business Climate Index, and we can see that that has come off quite sharply, and at the moment is actually at its lowest level since COVID. And then the other feedback that's come out of Europe is about 90% of businesses or manufacturers say that the Iran conflict and the stress that's coming through economically from that will affect business conditions negatively. And in response to this, the yields in their bonds have actually risen, which is not a good thing. You always want to see bond yields coming down. That's when bonds become more valuable. So there's some concerns that Europe could be more vulnerable to a stress at this period in time, which could raise inflation and drop economic growth. If we have a look at how different stock markets are made up around the world, the US markets have a far bigger exposure to technology-driven companies. In Europe, there's really just two big ones, which is ASML and SAP. What the graph on the right-hand side shows us is how the different stock markets around the world have reacted since the start of the Iran conflict. And we can see there that the white line is the European markets. They've actually been the slowest ones to recover since the war actually started. And this is because a lot of the recovery has been driven by technology stocks, of which there are fewer in Europe. So we've spoken about the markets having a structural difference. Have a look at the graph on the left-hand side here. It looks at labor productivity comparing the US, which is the blue line, to Europe, which is the red line. And we can see that the average productivity level in the US at the moment is just over 161. Compare that to Europe, just over 121. So significantly less productive economies in Europe than what you have in the US. On the other graph on the right hand side, we're just showing the forward price earnings ratios of the different markets. Now, yes, the US markets are a lot more expensive, about 50% more expensive than what you pay in Europe, but you have this greater exposure to a productive population overall, and secondly to companies like tech businesses, which are able to create significant productivity gains through things like artificial intelligence and more efficiencies from technology. If we have a look at the return outlooks, we can do that across the world in different regions. And the graph on the left-hand side here just shows you what the expected returns are from those markets over the next 10 years in US dollars. And Europe, although not terrible, is not as attractive as some other areas, particularly large cap or developed markets, more valuation-driven developed markets. It doesn't look as attractive as Latin America or emerging markets in general. Japan looks a lot better as well. And because of that, if we have a look at our portfolios, which is the graph on the right-hand side, the core wealth global strategies, whether it's the sterling ones or the US dollar ones, are generally slightly underweight Europe compared to what the peer groups are. And this is something that we've gone more for stock pickers who can find good companies, whether they're in Europe or America or Japan, and that has paid off for us over the last number of years. That concludes our monthly wrap-up for the month of April. If you've got any questions, please be in touch with us. Speak to your advisor. We'd love to engage around that. If you've got any specific topics you'd like us to cover in future, please leave a comment below on the social media posts or just get hold of us and we'll add that to future monthly wrap-ups.